Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is Complement Your Investment Strategy with Economic Understandings. My name is Shen Chu. I'm the moderator for this session. So, amid the concern about the US recession fear, today we invited a certified financial planner who is George Paul to share with us how do we interpret economic data and events and complement our investment strategies. Before we begin, as usual, disclaimer, whatever we share in this session is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you are solely responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. He graduated with Bachelor in Finance from Coventry University, UK. He is a licensed financial planner and financial advisors representative. He is the co-founder of E. Cameron with sharing contents of more than 1 million views. He has more than 11 years of investment experience and trained more than 1,200 working adults to master the wealth growth strategy in 3 years. So he is none other than Mr. George Paul. George, how are you today?
Hi, Shen. Doing very, very good.
All right. Good to have you here. Pleasure. So let me just quickly stop my sharing and stop my screen sharing and hand over to you.
Okay, thank you, Shen. Let me share my screens on it. All right. Can everyone view my slides now?
Yes, perfect.
All right, good. Right. Thank you, Shen, for introducing me. Welcome everyone to our today's webinar. We are talking about how to complement your investment strategy with economic understandings. Now, I already saw some of the participants has raised up some questions inside the Q&A. Don't worry, we'll cover it. And if I have not covered it in my slides today, you can still ask in the Q&A and we will do it later. All right. Now, what will we learn today? All right. Basically, I will let you know how to interpret the economic data and events, right? And then how to plan your investment strategy using the economic clocks. Okay. Some of you may heard it before, some of you may not. So today I will share about it. What is economic clock and why it is very important for us to use it when we are going to plan out our investment strategy. And last but not least, I will let you know how to take actions and get results in your investment strategy. Now, are you excited to learn our today's topic? Now, if you are excited, please comment yes, or please comment yes, so that I know you are very excited to know more about it. And I'm sure that every one of you has experienced these few days the market being very volatile. So yes, I think economic data is what you are looking forward to, right? All right. Now, let us move on to our first topic, or how introduction of key economic indicators. Now, over here, I will share a few economic indicators that are very, very important, okay? And I think most of us should know because we are doing investment. We need to know what are affecting our performance of our equities market, right? So let me first let you know what is the importance of these economic indicators. Now, economic indicators are very critical tools for investors because they provide us with insights about the health and also directions of the economy. And by interpreting these indicators, we can make informed decisions. Now, a lot of the investors, when we go to invest, right, we don't make informed decisions. We follow others. We follow rumors, we follow news. But how do you know whether your decisions or your investment, when you click on the buy, sell button, do you know, is this an informed decision that I made? You don't know, right? So we need to make an informed decision whenever we do investment about asset allocations, timing, and also our overall strategy. And economic indicators can be classified into 3 categories based on their timing relative to the overall economic cycle. Now, these 3 are called the leading, lagging, and also coincidence indicator. Now, each category of these, right, they serve different purposes. Okay, they serve different purposes. Now, let me just briefly let you know what are leading indicators, what are the lagging indicators, and also the coincident indicators, right? So by the name itself, right, leading indicators means these metrics, they tend to change before the economy starts to follow a particular trend. Okay, if this sound very technical to you, don't worry. That means that leading indicators are used to predict the future economic activity. All right, they are used to predict the future. Now, what about lagging indicators, right? Lagging means these are the metrics that change after the economy has already begun to follow some particular trend. Okay, can you name me some example, the lagging indicator that we often see? In the market or in the news, you often see that people talk about this indicator or the economic metrics that they use. Okay, right? For example, GDP growth. All right. Yes, GDP growth is what we call lagging indicator because they are somehow the indicators to show the performance of our economic activities in the past. Right. So these are the lagging indicators. Now, there are also the third type of indicators, what we call coincident indicators. Now, what is this? Right. So coincident indicators are the metrics that move in tandem with the overall economy. So put it into layman term, it means they provide real-time data on current economic states. Okay. Now, don't worry. I will share more about this all this type of economic data or the indicators later on. Right. So what are the benefits of understanding economic indicators? All right. Okay. If let's say you know the answer, just put into the comment sections below because there's no true or false answer for this. Everyone need to know the economic indicators with different benefits, because different people look out for different outcome. But first, for me, benefit of understanding economic indicator, first of all, it helps us to able to forecast the market trend because these indicators, they help us to predict the future performance of an economy, and it allows us to anticipate the market movement. Now, this is very important because investor, we often anticipate or we do forecast for the market to move, right? So when we forecast the market will move up, then we go and long the market, we buy the market to go up. When we think that the market is not good, maybe we on hold our investment, right? So all the investors, we need to know how to forecast the market trend. Now, understand economic indicators might help us in forecasting this. And second one, okay, it helps us with risk management because understanding economic conditions, it helps us to manage our risk by adjusting our portfolio to mitigate some potential downturns. Now, I give you some example. When you saw the GDP growth for a country, some large economies, for example, United States, right? When you saw that the GDP growth is slowing, or we say there are no growth seen in the past quarters, what will you do? All right, with this kind of indicators, what will you do? You will start to mitigate your portfolio. Maybe you wanted to, to take profit from your current investment into the US equities or in equities market as in overall, just to protect your risk, right? So indicators help us to do risk management. Now, thirdly, okay, understanding economic indicators also help us in making informed decisions. Now, I have mentioned just now, right, why we need to know about the economic understanding. Because with data-driven insights, it reduces our reliance on guesswork. You don't need to guess whether the market will go up or down. With data, with indicators, you can make informed decisions. And it rules out all the emotions that will involve in our investment decision making. So it is very important and it helps us to make informed decisions. And last but not least, it helps us to do strategic planning. Now, investors, we need to do strategic planning for our investment. No matter you are investing into equity stocks market, you're investing into unit trust, you're investing into real estate or whatsoever, we need to do strategic planning. Now, understand economic data can help us to align our strategies with the economic cycles. Because different economic cycles, it favor different asset class or industry. Do you agree with me? Come, if let's say you agree, say yes, right? And it helps us to optimizing our returns based on whether the economy is expanding, peaking, contracting, or they are in the down. All right. So these are the 4 benefits of understanding economic indicators. All right. Now, let me share you 5 key economic indicators that most of us will see this or read it in news, in all the some economics, they will talk about it, right? These are the 5 key economic indicators. Now, first of all is GDP. Okay, it means gross domestic product. Okay, in layman term, it means how well this country is making money. That's it. All right, this is the gross domestic product. Now, second one is unemployment rate. Okay, why we need to know about unemployment rate? Because we need to know whether this country or these economics, are they or are their people are working. When you work, you get money, you spend money. So economic growth, easy, right? Next, I think this word or this phrase has been in the hot topic for most of the people. We call inflation. All right. So inflation means, okay, how our goods or the cost of our goods go up. Okay, the price of our goods or our cost of living go up. Okay, so this is affecting our living costs. All right, very easy to understand. Now, the fourth one is interest rate. Okay, we need to know about interest rate. And the last but not least is the retail spending or the consumer spending. Now, I have a question for all of you. Can you let me know what type or what category is interest rate? Just like I mentioned, right? There are 3 categories. First is the leading indicators. Second is lagging. And the third is coincidence indicators. Now, can you let me know what category does interest rate fall into? Okay, put your answer into the comment because I wanted to know whether you have some basic knowledge on these economic indicators or not, right? Can anyone just name it? Okay, do you think interest rate is a leading, lagging, or a coincident indicator? Okay, some people say leading, some say coincidental. All right, what else? All right, now all of you are correct. Okay, whether it's leading, lagging, or coincidental, you are right. Let me explain why. Okay, in a very fast pace. All right, so why interest rate can be lagging? Okay, you see, when central bank they reduce or they adjust the interest rate, they sometimes will consider response to some past economic data. All right, I give you some example. In current market condition, everyone is talking about whether the Fed, the US central bank, whether they are cutting the rate, the interest rate, but they are not cutting anytime soon now, right? So why? Because they are referring to some lagging indicators in the past, the employment rate, the inflations, to make sure that they do a right decision whether to reduce the rate or to maintain it. So in this situation, interest rate can be considered as a lagging indicator. Now, it also can mean it is a coincident indicator because current market interest rate, they often reflect the present economic conditions and the central bank view on their monetary policy. Okay, so they also can be viewed as a coincidental indicator. Now, they also means interest rate can be leading indicator. Let me tell you why. Okay, because when market, we have some expectation on the future interest rate changes, right? Some, some asset class, some market, they will start to move. Let me give you one more example. All right. When we talk about US equities market, right? Everyone is expecting, or forecasting the interest rate of the US central bank, the Fed, the Federal Reserve, right? So when people are forecasting the changes into the future interest rate, the market will move because market sentiments move ahead of this. So when people forecast using the interest rate, then interest rate become a leading indicator. Now, I know this is very tricky, but yes, interest rate can be either one of them. All right. Right. Okay. Now, let me move on to give you more explanation on each of the economic indicators. All right. So the first one is gross domestic product. Okay. What it is? It measures the total value of all goods and services produced within a country. Okay, over a specific period. So we usually measure it over every quarter, every year. All right. And this is a very comprehensive indicator of the overall economic activities because it measures the total value, of all. Okay, so I'm highlighting some important words. All right, all goods and services produced in the country. So, for example, all the foods that you consume, all the services that you use within the country, they will contribute into the GDP of Malaysia. And why it is very important? Because first, it indicates our Malaysians' overall economic performance or the overall economic performance of that country. Secondly, it helps us to determine the phase of the economic cycle of the country. All right. So when you look at the GDP, you know whether the country is in the which stage of the economic cycle. Okay, I will share about it later on as well. All right. And third, GDP will influence government to make changes on their monetary policy and also the central bank decision on the interest rate. Okay, so that's why we call GDP a what? Okay, which type of indicator is GDP? Right. I think most of you know. Right. Now, how do we interpret GDP? Okay, we'll talk about the importance of it, the elements of it, but how do we interpret GDP? Okay, let me share with you. When you see the GDP is in growing, okay, it's rising. All right. Okay, after today's sessions, you can go on to Google, search on the GDP of Malaysia, perhaps Malaysia. Look at the past 5 years of our GDP growth. If let's say you see Malaysia, our GDP is in rising, it's growing. What does it mean? It means that our economy is having growth. And it potentially will lead to higher corporate profit and stock market gains. Here's why. Okay, ask me why. All right. Okay, because when GDP is growing, it means the total value of the goods and services produced within Malaysia is also growing. So what does it mean? When these produce, when these profits are growing, it means corporate are making monies. Okay, so when corporate are making monies, stock market will work well. Okay, they will do very well. All right, so this is how we interpret GDP. Simple, right? Very simple. Now, what if the GDP is in falling? Our GDP is reducing or slowing. Okay, it means our economy is in slowdown or recessions. Okay, it means our economy is slowdown or recessions. Now, it may also lead to lower corporate earnings and stock market will start to decline. Okay, now let us try to recall back, right? What is the GDP in Malaysia in the past, let's say past 4 quarters? Okay, in the past 4 quarters, what is the state of our GDP? Okay, our GDP is growing, right? Our GDP is growing. When you see our GDP is growing, okay, we can expect that our stock market is also growing. Am I right? So we can see this year, okay, let us rule out what happened this week. Let's rule out this first. In the first half of the year, is Malaysian market doing very well? Is our KLCI index doing well? And all the others indexes, they are doing well, right? It's because of we are seeing the GDP is growing. Am I right? Okay, so now with this example, I believe all of you, okay, if not all, majority of you know how to interpret GDP. All right, then let me just move on to the second economic indicator. Okay, now we call it the unemployment rate. Okay, so what is unemployment rate? Simple. It is a representative of the percentage of the labor force that is unemployed. That means they have no working, they are not working, all right, tak ada kerja, all right, then and they are actively seeking for employment, okay. So those who are not actively seeking employment, they will not be calculated into this because the government also don't know people are looking for jobs, right? All right. So why unemployment rates is important? Okay. First, it reflects the health of the labor market. Okay. If some of you are in the headhunter industry, human resources industry, you know the current situation or the condition of our labor market, then you will also get some idea of how well is the current state of our labor market. But unemployment rate is official indicators for us to know the performance or the current situation of our labor market. All right. And it will affect the consumer spending and also confidence level, okay, which will also be very important for our economic growth. Because when we as a consumer, we don't spend, we are not confident to spend, the economy is not going to grow. Am I right? Okay, so unemployment rate is very important. And last but not least, it will influence the monetary policy decision of the central bank. Okay, whether the central bank, they want to reduce the rates, the interest rates or not, these will affect. All right. Is it included the foreign labor? No, it only it includes the Malaysians. Okay, it only includes Malaysians. All right. But yes, foreign labor, they will affect our labor of our unemployment rate because some works we have to hire some foreigners, right? So it will affect as well. Okay. So this is why unemployment rate is very important. Now, how to interpret? How do we interpret unemployment rates? All right. Now let us look at it. Lower, or we are seeing low unemployment rate, it means a strong labor market. Okay. It means that people are getting jobs. Okay. When we are seeing strong labor market, we're also anticipating higher consumer spending. And it will reflect in our GDP where our economy will grow. Okay. And what if we are seeing that high unemployment in the country? What happened? It means that a lot of people are losing jobs or a lot of people don't have job. So when people don't have job, our economy is in distress situation. And of course, when people are in distress, lower consumer spending and potentially it will lead the country into recessions. Okay. Now, anyone know what happened to the US market last week when they announced their economic data and what caused the market to drop tremendously this week? Anyone know? Okay, everyone know. If something happened to the unemployment rate, people are, yes, all right. Some people answered it correctly. Increasing unemployment rate in the US market. And it is beyond the forecast of the market. So when it is beyond the forecast of the market, people are getting what we call it. People are getting worried about it. Okay, people are getting worried about it because wow, unemployment rate is higher. That means it might brings or reflecting in our lower consumer spending in the coming months or in the coming quarter. So people are worried about it and it causes the market sentiment to be bad. Okay, but there are more economic data that combine and cause the market to drop. All right. Now next, okay, I believe everyone know about unemployment rate. I have given the example. Now let us move on to our third economic indicators, which we call inflation. Okay, now inflation can be measured by consumer price index. Okay, can be measured by consumer price index. Now what it is? Okay, it means the rate at which general level of prices for goods and services is rising. It means goods and services price are rising. And this CPI is used to track the changes in the price level. Okay, it's used to track the changes. Okay, now why CPI or inflation is important? Because it will affect our purchasing power and our cost of living. Okay, I believe this is very, very familiar for all of you because we have been talking about inflation in the past, I think 10, 20 years, we are talking about it. And I think people make comparison, of the prices of Milo, or the prices of roti canai, or the prices of cup of teh tarik in Mamak store. People are talking about it 10 years ago, what is the price, and then what is the price currently, in a Mamak store. People are comparing it. So this is what we call inflation or CPI. And it will affect our purchasing power because in the past, maybe 100 ringgit can buy you a trolley of goods, of groceries. But now, with 100 ringgit, maybe you can just buy, half of a trolley or a quarter of a trolley. We don't know, right? So this is affecting our cost of living. And secondly, it will influence the central bank, on their policies towards the interest rate, whether they need to increase the interest rate or they want to reduce the interest rate, So this will affect it. And last but not least, it will impact the corporate earnings. Now, let me ask you one very tricky question. If the inflation is very high, what do you think will be the impact towards some consumer companies, some consumer related stocks, whether their earnings will be good or their earnings will be bad? Anyone can just make a wild guess, right? Yes, the earnings will be affected, but for these consumer related stocks, whether their corporate earnings will be good or their corporate earnings will be bad. Okay. Now, yes, people are giving, answer. Yes, you're right. So if we say it's a consumer discretionary, that means these things are, things that we need to buy every day, some are daily goods. You can see the corporate earnings is going good because they have to increase the price to offset their costs. All right. So who is the people to bear the cost? Us as a consumer. So the corporate earning for consumer discretionary companies will be good. But for consumer staples, now what is consumer staples? They mean these are some luxury goods. This is not a needs, but a wants goods, some luxury things. So this will be bad because people no money to buy these things. Okay. Very simple example I given to every one of you. Right. Now, how do we interpret inflations? All right. Okay. Now, check it out. Okay. Now, in the rising inflations, it will erode our purchasing power and it may lead to higher interest rate. Now, why it may lead to higher interest rate, I will explain to it later. We'll talk about interest rate later. All right. And it might negatively impact the stock market valuation because everything is expensive. People are not spending, economy are not growing, the market will be bad. All right. Very simple. But what if the inflation is in controlled situation? Okay. When you look at this, right, we are not saying the inflation is reducing, but we mentioned as a controlled inflation because inflation is good for all the economies. Okay, all the countries we need inflation so that our goods is is raising prices. Our GDP is also growing, so we need inflation. But when there is a rising inflation out of control, that means the country, the people are very scared about it. But when there is a controlled inflations, that means the growing states of the prices of the goods and services are within our control. So we also can, we can tahan a bit. We can tahan a bit. All right. So when there is a controlled inflation, it means a stable economic growth. Okay. That means our economy is very stable. Now, anyone know the benchmark of a controlled inflation? What percentage is that? Okay. Anyone know? All right. And it will generate positive for our equities market because it means our country economies is growing. Everything is growing. All right. Yes, I see the answer. So the benchmark for most of the country benchmark inflation is 2%. Okay, it's 2%. Right. Next, let us move on. Okay. Now, interest rate. What is means by interest rate? Okay. So interest rate is the cost of borrowing money. Okay. In simple term, it means that when you are borrowing money from the banks, interest rate will be the cost of it. But there are many level of cost of borrowing. There are cost of borrowing within banks. There are cost of borrowing within us as a retail consumer to the banks, and the also corporate or businesses cost of borrowing money with the banks. Okay, so there are few aspects that we need to look into it. All right, and interest rate will often influence our economic activities because it will affect our consumer spending, business investment, and also inflations. All right, and why this is very important? Okay, take note about it, because it will directly impact our borrowing costs. Okay, now when we talk about borrowing costs, everyone will need to borrow money from the banks. Whether you are an individual person, you're a corporate, we all need to borrow money from the bank to grow, right? So when you are going to get mortgage loan, you're going to get higher purchase loan to finance your car. You need some personal loan, to finance some other expenses and whatnot, right? So it will directly impact our borrowing costs, and it will also influence our investor decision whether we want to invest in stocks, bonds, and also other assets, because different asset class they move differently towards the interest rate movement. Okay, and last but not least, it reflects our central bank stance on economic conditions. Now, can everyone know, in the past 2 years, in 2022 and early 2023, what is the central bank stance of Bank Negara Malaysia? Are we increasing our interest rate? Are we reducing it, or what we do? Okay, in 2022, in early 2023, actually we are seeing increasing interest rate. Okay, not only in Malaysia but also in other overseas countries, especially in US market. Okay, they are rising their interest rate, but now they are reducing, or we are expecting people to reduce or to maintain our interest rate. And in the past few monetary policy committee meeting of our Bank Negara Malaysia, they have been on hold towards the interest rate decision. They mean they remain unchanged, okay, at the moment. So this is the current situation of our monetary policy stance of Bank Negara. All right. And how do we interpret interest rate? Okay. So when there is a rising interest rate, what it means? It means that the countries trying to slow down our economic growth, or okay, or it means they are increasing our borrowing costs. Okay, why we need to increase our why we need to increase our interest rate? Okay, maybe the market is very hot, or okay, yes, I see some answer. Yes, to slow down inflation. All right, because when people are spending a lot, there are a lot of money in circulation in the market, in the consumer market, then we're trying to reduce down, because we don't want the inflation to go out of control. So when we try to control the inflation, then we start to increase our interest rate. We try to make people not to borrow money, or in another way, we want people to try to save more into the banks. Am I right? When the interest rate is increasing, what will increase as well? Our fixed deposit rates. So people are saving more. No, so the banks is attracting more people to start savings. So when they are increasing the interest rate, they want us to stop spending a lot. Okay, but when you increase the interest rate a lot, when you increase too much of it, it will also cause another situation like what we are seeing in the US market. When they are increasing a lot, but the inflation still not within the control, what will happen? People are expecting, oh, there might be recessions coming, right? So this is what happened to the in the US market, or in the overall global scene. Okay, now what happened when the interest rate is in rising? It usually, or oftentimes, it will lead to lower stock prices. Okay, because the corporate earnings might get impacted because of the borrowing cost is increasing. Then not good for the corporates. So their corporate earnings might get impacted negatively. All right. And what if there's a falling interest rate in the market? It means the economy, or the central bank, they are trying to stimulate the economy. They are trying to stimulate the economy by reducing the interest rate. So people borrow more, or people stop saving, but they take out the money to start spending or to start investing. All right. So this is why people, central bank, are reducing the interest rate. Okay. So the borrowing cost will get reduced, and it is a potential boost to the stock market. All right. Now, we have covered 4 key economic indicators. Now, let us move on to our last economic indicators, which we call the retail sales or the consumer spending. Now, what does retail sales measure? It is a key indicator of our consumer spending, and it measures the total receipt of the retail stores. Okay, it simply means the revenue, of the retail businesses. And why this is very important? Because it indicates the consumer confidence level. When you are confident, you spend more. When you're not confident with the market, you don't spend. All right, or you spend lesser. So this is a very good indicators for us to know the consumer confidence about our current economic situation. And it also often reflects the health of the retail sector and the broader economy. And very importantly, it influences GDP and overall economic growth, because retail sales contribute part of our GDP. Okay, so this is consumer spending. All right, we need to know about it. Now, how do we interpret this thing or this data? When we are seeing increasing retail sales, what does it mean? Okay, I think after I share 4 key indicators, most of you already get to know about how to interpret the data. Okay, when there's an increasing retail sales, what will happen? Okay, consumer confidence level will increase. All right, that means strong consumer confidence. Next, people are positive about the stocks because people are spending more. Corporate earnings are increasing. It is good for stock market. But what if the retail sales is decreasing? What does it mean? Okay, it simply means our consumer confidence level is weakening. People are not likely to spend more, and we might potentially see negative growth in our stock market because of the corporate earning will get negatively impacted. All right, now I've covered all 5. Okay, not sure whether you clear about it, but I hope that my explanation is quite in layman terms. With some example, everyone can get to know about these 5 key economic indicators. Now, let me just pick one of the economic indicators and do some analyzing with every one of you here. Can we do that? Right? If let's say you're okay with that, just type okay in the comment sections. I'll move on to let us analyze the economic data together. Okay. Now, I would like to give you some example of the GDP, okay, of Malaysia. Okay, of the GDP of Malaysia. Now, let us look at this data. Okay, let us look at this data. When we see that the Malaysia economy, okay, in the past 1 year, in 2023, our GDP growth rate is in 3.6%. Okay, and in 2022, our GDP growth rate is 8.9%. Wow. Don't you think that, in 2022, our GDP growth is very good? Okay. And 2023, we only get 3.6%. Okay. Yes. All right. If you can see from the data, okay, you can see from the right-hand side, there is a chart of the past GDP growth rate of Malaysia market. And you can see we are averaging 4 to 5% every year. Okay. But in 2022, what happened to the global market? We are in COVID-19. So economy is not growing. We are in the negative territory. So our economy is not growing. Instead, we are reducing. So we have a negative 5.5% growth. With that low base in 2020, in 2021, we started to see some economic growth, in 2021. And 2022 is the full recovery year. That's why we are seeing very good GDP growth rate in 2022. So for me, these 3 years is what we call not a average year for us to view. Okay, so in 2023, we started to see the real economic performance or activity of Malaysia, and we are seeing a reducing growth rate. Yes, we are still growing, but our growth rate is reducing at 3.6%. Okay, now let us move on to break down what are the sectors that contributing to our GDP. Okay, now let me just point out a few. They were separated into production approach and also the expenditure approach. Now all this data we got it from Department of Statistics Malaysia, compiled by Bank Negara. Okay, you can see. Let us look at the production approach. You can see that services contributed around 60% of our overall GDP. Okay, services. Then okay, with this information, we know that okay, Malaysia GDP is growing. Okay, if let's say all the services industry is doing well, then Malaysia GDP likely will go higher because about 60% of it contributed by these sectors. Now, the next one will be the manufacturing sector, okay, which contributed about 23% of our overall GDP. Okay, so whenever we saw this kind of data, right, then these are the sectors that we need to pay more attention because these are the major key drivers of the Malaysian GDP. Okay, and yes, this information we can get from Department of Statistics Malaysia, open data. Everyone can view it whenever they have the new data coming up. Okay, now, if let's say we want to switch on to the expenditure approach, then we can see about 60% of our expenditures or the GDP contribution are from private consumptions. That means us as a retail consumer, okay, we contributed a lot towards the GDP as well. Okay, all right. And next, what are that? Is 20% from the gross fixed capital formations. Now, what is fixed capital formation? It means the corporate spending into their machineries, their equipments, they're expanding their factories, and all these are the fixed capital formations. So from this, we can see that, okay, services and manufacturing, they are the key drivers to Malaysia's GDPs. Okay, now let us move on as well. When we think that, okay, services sector, they are the main driver of Malaysia's GDP, let us also break it down. Okay, let's see. When we do research, right, we need to know all about this. So when we break it down, we know that, oh, okay, wholesale and retail trades contributed about 30% of our total services. So when this happens, we know which one for us to look at. All right. And the next thing will be government services. Our spending on government services also contribute about 15% of our overall services GDP. Okay, so from here we know, okay, these are the main niche industry that contributed towards our GDP growth in Malaysia. Okay, now with this kind of example of analyzing, I hope that you all also know how do we interpret. It's not just as simple as we are looking at the rising or the reducing, but we also need to go and look up at the breakdown of it because we need to know what are the key driver of the countries, so that when the industry or the sector is doing well, you know that high chances that the country GDP is also growing. Okay, clear? Now, after we have break down the economy data, let me just share with you some of the sources of reliable economy data that you can use openly to do more research. First is Department of Statistics Malaysia. They cover most of the Malaysian economic data. Next, we can see is Bank Negara Malaysia. They also compile good numbers of Malaysia economic data as well. And they will often do some quarterly bulletin to share with us on their interpretation as well on the economic data. Now, if let's say you are looking out for, beyond Malaysia, you're looking for Singapore, you're looking for Hong Kong, China, US, Europe, World Bank is good sources for you to look for data. It covers a good number of global economic data as well. If World Bank didn't cover what you are looking for, you can also look for International Monetary Fund, IMF, for some good amount of global economic data. And last but not least is the trading economics. Okay, they also share some global economic data, but yes, some of them are free, some of them are paid informations or data that you need to pay money to get it. All right, so these are the 5 sources of reliable economic data that we can get. Okay, now all good for getting the basic or the fundamental of economic indicators. All right, if good, then we are moving on towards our second part of it, which is how do we plan our investment strategy using economic clock. Are you ready? If you're ready, just type in ready for me. All right, let me just get a sip of water. All right, if you are ready, just type in ready. Okay, everyone's ready. Now let us move on. Okay, all right, now we are talking about investment strategy using economic clock. So first of all, I need to introduce to you what is economic clock and then how do we use it. All right, so the economic clock is the metaphorical tool for us to visualize the cyclical nature of the entire economy. Okay, and it also illustrates how economic activities work, follow a repetitive sequence over time. You know, people often say that the market often repeat itself, right? I think most of you heard about this quote before. People always say the market is in repeated nature. So they will always come back every 10 years or 20 years, right? I still remember, you know, this week when the market is having some heat, people are talking about, oh, we are in the 20-year cycle of our 1987 crisis and also our 2008 crisis. And surprisingly, now we are heading somewhere into the 20-year cycle. People are talking about it. Right. So whether it is true or not, you don't know. Okay, because these are all historical. And diagram on the right, and I show you is the investment clock by Merrill Lynch. Okay, they are very famous in asset management company in the overseas in US market previously. Okay, so these are the investment clock that they the design. Okay, they design for us to look at the economic cycle. Okay, and which sector or which asset class will be benefited during that certain economy cycle. Okay, right? Some people said it's a sector rotation. Yes, you can see, right? So let me just give you an example. Using this investment clock by Merrill Lynch. Okay, let us look at the top right. You can see there's an overheat. It means that the economy is inflation is rising out of control. The market is overheat. Then they tell you, right, in this cycle, what kind of products or industry or sectors will grow well. Okay, they mention is commodities. Okay, why? Because their prices are rising. You know, the oil and gas, you know, the crude oil, the palm oil, and the energy, you know, the natural gas, everything is rising. So they say, oh, these are some sectors that they were benefited in this sector, in this cycle. And they also say that industrial might be good, you know. So these are the how do we interpret these investments clock in particular. Okay, now, but we are not going to talk about this investment clock yet. We talk about a very simple one, the 4 phases of economic cycle. Okay, this is very simple because all the economies, they need to go through these cycles. Okay, we call it 4 phases. First is expansion. Okay, that means the economy is growing. Okay, when the economy is growing up to a certain level, we call it a peak. Because they have reached a peak, they can grow no more, then they will start to slow down, right? So when they start to slow down, we call it a contraction period or a contraction phase. When we are seeing some, you know, some slowdown in the corporate earnings, some slowdown in the economic growth, okay? And when it slow down to a certain level, it will hit the bottom as well, what we call a throat, okay? So when it hit to this level, it will start to rebound. So we call it a recovery period. Okay, now just give a wild guess. What do you think that our Malaysian economy is in these four phases? Which phase do you think that Malaysia economy is currently in, and where we are heading to? Okay, all right. Okay, some say recovery phase. Okay, some says expansion. Some people say peak, maybe. Okay, we don't know, right? Right. Let us move on. All right. I'll explain to you each phase of it, right? So in expanding phase, we are seeing economic growth and increasing prosperity. That means the country is doing very, very well. Okay. And this phase can last for several years. That means the country need to grow, expand in many years. They're not going to grow 1 year and then start to hit a peak and then go down, right? So the countries will do very well for a few years, and you can see some robust economic activities going on in that country itself or in the regional market. Okay, so here are some of the characteristics. Let us see whether we are in expanding phase or not. We will be seeing GDP growth. Okay, if let's say the country is in expanding phase, we will also be seeing rising employment level or decreasing in our unemployment rates. Okay, and in terms of consumer confidence, you can see people are more confident in spending or in buying more things. All right, and in terms of inflation, we can see there are moderate or rising inflation as demand increases because people are spending more, so there are more demand than the supply in the market. And last but not least, we can often see the interest rate will be often very low, but they may start to rise, because they want to end this spending phase. Now, with this characteristic, do you think that Malaysia is in expanding phase or not? Okay, because just now I saw some people say we are in expanding phase, right? With this characteristic, do you think that Malaysia is in the expanding phase, or do you think any countries they are in this phase? Okay, all right, I will cover it later. Now let us move on to our second one, which is the peak phase. This marks the highest point of our economic activity before a downturn. That means in this phase, we are highly likely to see Malaysia economy is going to be stagnant and then start to slow down. All right. So some characteristic in terms of GDP growth, it will start to slow down and then it might plateau in some level. Okay. And in employment rate, we can see high employment, but the growth is start to decelerate. It means the growth is slowing down. Okay. And consumer confidence is still very high, but people start to worry about inflation. Okay. People start to worry about inflation. And when there is inflation, okay, it might always be growing at the peak. Okay. And in terms of interest rate, you can see the central bank started to increase the rate to curb inflation. Now, with this, do you think that Malaysia, we actually just passed this peak phase, or we are in this phase 2 of the economy cycle? Okay, I leave it to you to decide, right? Now, third phase, we're in contraction phase. Okay, the contraction phase means the economy is in declining. Okay, or what we call in recessions. Okay, now what are the characteristics? In GDP, we are seeing some decreasing GDP growth. Because the country is not growing, we are having into a recession. And next, you can also see a rising unemployment rate. Okay, because when the market start to stagnant, no people are getting jobs, or companies start to cut jobs, or they start to retrench people. All right, and in consumer confidence, when the economy is no longer growing, people has lost their confidence toward the retail market. People are not going to spend more money, so they start to reducing their spending. They start to reduce their investment. That's where the consumer confidence is lower, and inflation will start to slow down. Okay, inflation will start to slow down. We might see the inflation slow down back to the control level, or sometimes we will see the inflation even not growing. Okay, as what we are seeing in the Japanese market for the last 30 years. As you can see, their inflation is not growing. Somehow they are into a deflation level. Okay, this is what they were being through, okay, by the Japanese people or the market. So for the interest rate, you can start to see central bank, they may start to lower down their interest rate. because they want to stimulate the market, okay, to start to spend more money, to start spending, to start borrowing, to keep the economy growing. Okay, so this is the contraction phase. And last but not least is the recovery phase, or what we call the trough. It means the lowest point on the economic cycle, and it is a signal whereby we are seeing some recovery into the economic activities. Okay, so here are a few characteristics of it. First, you can see GDP growth because we are already at our lowest point. So anything, good, positive to the market, it will start to drive our GDP to grow and to start stabilize. Next, we can also see there will be high unemployment rate, but we started to see some stabilizations, and we can also see some reducing unemployment rate when we head into our expanding phase or recovery phase. Okay, plus, and also the consumer spending, you can see people are getting very less confident. People are not going to buy, but somehow we can see also people are started to show some improvement in spending. All right, so this is what happened into recovery phase, and it often takes some years because it takes years for us to go on from the third phase, which is the the third phase towards this recovery phase. It means we are not increasing, we are not expanding, and the inflation as well. We will be into a low inflation because of no confidence into retail spending, and also interest rate will be very low. All right, so the central bank will aim to stimulate the economy by spending, by start to reducing it. Okay, so this is what happened in the fourth phase, right? Now, let us just guess what are the economic phase that we are in after I have explained all these four economic phase that are, each of them. Let us just do a wild guess, right? Now, moving on. Because when we know about our economic phase, then only we can plan our investment strategy. Agree with me? Right? Are you agree with me? All right. For different asset class or sector, okay, in different economic phase, there will be some sector will be benefited from that particular economic phase, and some may not. All right. So how do we plan for our investment strategy? First of all, we need to study which economic phase is good for what type of sectors or asset class. For example, stock market, bonds market, what else? We have property markets. Okay, which markets will going to benefit in the particular economic phase? So we need to study about it. All right, when we are doing our planning out our investment strategy, and we also need to know which sectors is going to be negatively impacted by it. Okay, because in every market, in every phase of our economy, we will have some beneficiary, and some people will get negatively impacted. So we need to know about it so that we can move some of our exposure or our allocation out of the asset class into those which will be, favor in the next economic stage. And we also need to know, should I rebalance? And how do I rebalance my investment portfolio? Very important. And the fourth one will be, what our allocation be like during different economic phase. Okay, but due to the time constraint, today I couldn't share more on how do we do this step by step. But here are some, here are some tips on what we should look for when we are going to plan our investment strategy after we know in which economic phase that we are in and how likely we are going into the next phase. All right. Now, okay, I saw some question here. Let's just put your question into the Q&A. I will answer it later. And let me just quickly move on with our third part of it, which is to take action and get results. Are you excited to start to take action and get results? If you are, just like yes, type yes in the comment sections below. All right. Put yes, give me some thumbs up, or give me some love, All right. Because I'm going to share with you how do we start to take action and make profit in our investment. Right. First of all, we need to set our investment goals. Okay, this is a very simple, a basic, a fundamental whenever we are into investment planning. First of all, we need to set our investment goals. And here are 5 steps for you to set the goals. And why? Because setting a clear investment goals and objective is the foundation of any successful investment strategy. Okay, it's a foundation. So if you don't set your investment goals right, you are losing your first hand into investment. Now, this is very important. So setting this right is the foundation. And goals, it provides us with a direction and also a roadmap for us to making informed investment decision. Now, that's why we talk about in economic indicators today, because this will be part of our investment decision making process, and by understanding what you want in your investment, it will help us to achieve it in selecting the correct or the right investment vehicles and also the strategies. Okay, are you ready? Now, let me just share with you the 5 steps in doing your investment goals. First of all, define your financial goals. Okay, what do you want to achieve in the next 2 years, next 5 years, next 10 years, in the short term, medium term, and so long term. First of all, you need to define it first. Next, I mean the second one. So next, you need to specify our objective. Why do we invest in it, and what is our current investment objective? Because when we already have our goals, we need to find out our objective. For example, your goals is to hit 5 million investment asset in the next 10 years. Why? What is your objective for hitting 10 million or 5 millions in 10 years time? For retirement planning, for your children education planning, for your to travel around the world dreams planning. What is the objective? You need to write it down. All right. And the third step is to determine your risk tolerance. How much can you stomach the risk associated with the investment that you make? Because some people just couldn't bear with the risk of stock market. Whenever they see the volatility in the stock market, they can't sleep at night. They start to get worried. They cannot work. In the day. So you need to know your risk tolerance. Whether you are a high risk taker, whether you're not, you are very conservative towards the risk management. You need to know about it. So there are questionnaire, there are tools to help you to identify that. Right. Now, the fourth step is the time horizon. You need to consider how long or what are the tenure that you have. You can start invest into it before you need to get the funds out for your users. Okay. So we need to know. We need to time it out. You need to know how long do we need this investment to keep generating profit for us. So the longer time horizon you have, it generally means you have high risk tolerance because we can bear the market short-term volatility or fluctuation. Okay. And the last step will be, what is your current financial situation and the constraints that you have and in this moment. Okay. So at the last step, you need to assess your current financial situation, including your incomes, your expenses, your liabilities, your existing investment, and what are the assets that you currently have to start to factor in as well some constraints, something like your liquidity needs, some things that you might need in the short term, because this is something that you need to rule out when you are calculating for your roadmap. Right? Now, last but not least, okay, because I believe today we have a lot to cover into our Q&A, I'm more likely to shorten my sharing. Okay, we always monitor our investment strategy and portfolio regularly. We need to do that. Okay, we need to always do that. Monitor it whether our strategy is working in current situation, in current economic phase. If they are not, then we need to start to rebalance our portfolio. Okay, so this come together after we monitor or observe or review our strategy or our portfolio. The next step will be, do we need to rebalance our portfolio to make it relevant to the future economic phase or the cycle, right? Then thirdly, we need to make sure our investment plan is responding towards our life changes as well. That's why we talk about setting your investment goals. Why? because investment goals for our future, it often reflect our life changes. If you are someone like me, in my late 20s, my next life changes might be maybe in the next 5 years, I will get married. Wedding will be one of the costs. I might need to start having my family. So children education is my, long-term financial planning goals. And perhaps also, I wanted to retire early, in my early 40s or late 50 or late 40s, then these are the life changes. So I need to make sure that my investment plan or the roadmap is aligned with my life changes, because you wouldn't want to plan out your investment plan for the next 10 years without taking consideration into your life changes. If you are not, then you are likely jeopardizing your own investment portfolio, because that might be some ad hoc or emergency needs of that money for you to take out from your investment portfolio. So we need to always make sure our investment plan, all right, our investment plan is responding to our life changes. All right. Now, let me just do a summary. Today, we have learned about the 5 key economic indicators and the implications. And I hope with today sharing, we can start to look at what happened in the past 2 weeks or in the past 1 week. Start to look at the economic indicators that's just been announced or released by some countries, even in Malaysia. Look at the economic data and start to do some, interpretations on your own, because we learn about it, the 5 key economic indicators. Go and study about it, research, and make your own forecast for the next, half year, for the next 1 to 3 years, which economy phase that we are going to be in. And from there, I believe that you will be able to start change or implement some amendment or some correction into your investment strategy where you deem necessary. All right. So that are the 5 key economic indicators. And in the second part, we also explain how to use the economic clock, about the economic phase, which phases that we are in, and how to complement it into our investment strategy. Right, what I mentioned just now, right? And last but not least is to setting your investment goals. Very important, using our 5-step strategy. And I hope after today's sharing, you'll be able to do a very comprehensive investment strategy, aligning yourself or your plan or your roadmap with the economic data and the indicators. And you will know, okay, after you are having some understanding about these data, the indicators, you know what happened when the market is, increasing, is booming. You will know what happened when the market is reducing, and you will get more prepared when this kind of thing happen, because you are well aware of all these economic data. You know the future of it. All right. So that's all from my sharing today. I think we are heading into some Q&A sessions, and I assume there will be more question on it, right? So let me just stop sharing. I pass back to you, Shen.
All right, thank you so much, George, for sharing with us how do we interpret economic data and events, and how do we understand the economic clock that you just shared. All right. So if any questions to ask our speaker, please write your questions in the Q&A box, and we'll address them accordingly. All right. George, on my screen, there's the first question is, what is PMI and how do we use it to read this indicator? All right, I think PMI is an indicator that you didn't include in your slide just now.
Great. So PMI, I didn't mention in my slides just now. It is also very important. So PMI stands for Purchasing Manager Index. If some of you don't know, right? It's a Purchasing Manager Index. It means okay, let me just give some history about it, right? So purchasing manager is someone in the manufacturing, or we say in the companies, that they go out to purchase, to make purchases for the company in the next quarters, 6 months, or the next 1 to 2 years. They are the one who are doing the purchasing. All right. So this PMI is going to reflect the confidence level of all these purchasing manager, whether they are confident to do more purchases in for the futures orders or they are not. So what PMI actually measured is the confidence level of what we say the overall manufacturing industry. All right. So they are a benchmark. Whenever you see a PMI level is below of 50, okay, it's a half of 100, right? So if the PMI is lower than 50, we call it a contraction period, where the factories or the companies are not spending. They are not confident enough to spend more for the short to medium term. All right. So when they are in more than 50, let's say they are in 51, 52, then we can mention that the purchasing managers, they are more likely, they are very willing to spend more, so they are very optimistic about the growth of the industry. So whenever you see this, you can also assume that the market is in good or in optimistic level. Okay, so this is what PMI measured. Okay, great. So it is a leading indicator, yes, because it's measured the future orders as well, right?
Thank you so much, George. The next question is by Eugene. I read from many books from great investors that economic indicators are important, but we should not be too distracted by the macroeconomic factor, but focus on the companies that you invest in. So what are your thoughts in this?
Okay, good question from Eugene. Yes, for me, I always study the macro because us as an investor, first of all, we need to know about our investment goals and our roadmap. So as I mentioned just now in our 5-step strategy, we need to know our time horizon. How long do we have to invest? Because for most of the people, if your investment tenure is 10, 15 years, of course, we have a longer time frame to time the market. But we often tell people don't time the market, right? But we need to know the macro, because if you know the macros, then you are likely to make a good strategy or use the right strategy in that economy phase. For me, it's a bonus, because to select a good companies or fundamentally, well companies is the foundation or is the fundamental for value investing. We must pick the right companies. But what if you pick the right companies, but they are not in the right sectors in that particular economic phase? What will you do in terms of your strategy? It might mean that the companies might be in a very low price or undervalued for you to start accumulating it, right? So we need to always complement our investment strategy with the economic data or the macros. So it is also very important. But for me, a fundamentally sound company is the foundation of it. And macro is just for us to plan out our investment strategy and to make sure we do the right things at the right situation or the right time. All right. I hope we answer the question from Eugene.
Thanks, George, for sharing your perspective. The next question is by Maslan. Salaries of Malaysian civil servants will go up by 15% to 47%. That is detailed in budget 2025. So can Malaysia afford this technically, since government services already made up 15% of the total expenditure? What is your view?
Okay, great. This is a good question. I also read about this news. I think just today or yesterday. Our Prime Minister talked about it, right? So yes, the salary of a Malaysian civil servant go up. It will affect a few things. Okay, and we need to always study our economic data. So when government are spending money on civil servant, right? It will cause our we need to question first, or we need to ask ourselves this: do our government have this kind of money to raise the salary of our civil servant? First thing. And if our answer is yes, then we need to go and find out where does the income from? Where does the income derive from? We need to study the income of our government. Then this will involve, a thorough study or a detailed study to our GDP, and also our government spending itself in, you can look up for DOSM or Bank Negara for this kind of data, right? But for me, okay, just now you mentioned that because government services, I think your question is that the government services has already made up about 15% of our expenditure. Would it affect? Yes, I think government starts spending more, it means our GDP might also get affected positively because they are spending more on it. Just that whether we have the money to spend, because we need to understand one thing: GDP growth, it doesn't really reflect our economy debt level, okay? Because some countries, they often raise money through government bonds just for them to afford for the expenditure. So we need to also look out at that. And this is not covered in my today's economic indicators, the 5 key things. So we also need to look at it. If let's say Malaysia, we are raising more debts just to afford for this government expenditure, then we might not in a very good situation, or maybe we are making a I can say we are making a wrong economy decisions from our government or our rule makers. But yes, these are something that we need to look out for. For me, different aspects that they might get impacted, and we need to study more about it. Yeah, I hope I answer for Mazlan on this.
Thanks, George, for sharing your view. The next question is, just now you have covered a number of economic indicators. So can you elaborate on the specific indicators that you believe are the most crucial for investors to track and why?
Okay. Can you repeat the question again? I'm actually looking at the question.
Yep. So the question here is that just now you mentioned a couple of economic indicators. So which one is the most crucial for investor to track and why?
For investor track,
To track.
for investor to track. Okay. It depends on which country we are actually in. For Malaysia, I think here are a few things. The 5 key indicators that I mentioned just now, these are relevant to all, I think, if not all, if not majority of the countries. These 5 are very important. And for some countries, they are relying more on exporting. Export data is also very important. Countries like Malaysia, because just now we mentioned about 60% of our GDP contributed from services sector, and about 20 over percent come from manufacturing, right? So when it comes from manufacturing, one aspect we need to look at is whether we are exporting a lot of our manufacturing goods towards other countries. So if yes, and indeed it is a yes, because we are exporting a lot of our E&E goods towards other countries. So when this happen, then we also need to track it down. So why just now I explained to you how to analyze the economy data? Because you remember I break down into the GDP, right? Because from there we will have a good view on which are the key driver of the economy, and then we go on to identify the key indicators of that particular sector or the industry for us. So export data is important for Malaysia. If let's say you're looking at US, then I think services, consumer spending is a very key indicators that we need to look at. And also these 5 others key indicators, they are very important. So you need to look at a few or several indicators to track the economy, whether which phases we are in. All right, and make your decision on it.
All right, thanks, George. And just now you talk about the 4 economic phases, right? So
Yes.
I've seen a couple of online attendees asking, so which economic phase are we in right now? Do you want to review it now?
Okay. Okay, let me ask you, what do you think after I share the 4 economy phases, right? Which phase are we in Malaysia? Okay. What do you think? Okay, let us look at the 5 key economic indicators, right? Just like I've covered it. So in GDP, are we in growing? Our GDP growth? Okay, we are seeing our GDP is growing, right? So next we turn into our inflations. Are we seeing our inflation in rising, out of control? Okay. we have seen it in the past 2 years, right? So we have seen it, and now we are expecting it to start reducing, slow down, right? Then the next one is our consumer spending. What do you think as a consumer, retail consumer? Are you confident to spend now, or you are more reluctant to spend but actually to save more money? Okay, so these are the third thing. All right, and then the fourth one will be the what we have covered three, right? And then the fourth will be the interest rate. Okay, I've mentioned about our Bank Negara interest rate decision in the past 2 years, right? So currently our interest rate is in the peak. We might start to reduce it soon. And last but not least, can't really remember what are the five economic data that I mentioned just now. Okay, unemployment rates. Okay, our Malaysian unemployment rates is actually slowing. Okay, we are seeing a slowing in our unemployment rate. So with these five indicators, I believe you already can guess which economy phase we are in right now. Okay, we can likely see it, right? Okay, we are starting to be in our third phase. For me, I think we are started to in our third phase, but this time round, we might be seeing some difference because some of the sectors are, and I mean overall economy, because we just recover from COVID-19. Some say we are in recovery of phase 4, some in expansion. But for me, we actually might start to see in phase 3, we are started to facing our step 3, and we are actually moving from our phase 2. But for me, it's very tricky because our GDP is not very high right now. So for us to come from straight phase 2 to phase 3, our GDP growth might somehow in stagnant. But we are seeing people are reluctant to spend now. So I think we are in somewhere around phase 2 to phase 3 for me. Okay, based on my research and my understanding, we might be in phase 2 or phase 3. Maybe Shane, you have some different different understanding on it.
Yep, I think I will just go along with your idea.
Great.
All right. So the next question is on the Malaysian ringgit. Okay, now we know that the ringgit recently strengthened against the US dollar sharply. So what will be the reasons for that, and will it be good for the import counters and bad for the export counters? And is there any indicators for track the current situation of current forex situation?
Yeah, I'm not a forex expert. Let's put it this way. Give some disclaimer for myself first. But yes, recent ringgit strengthening, I think not mainly because of Malaysia, but I think the key driver is actually in US. Because as you know, in the past few years, our ringgit to US dollar, we've been depreciating, right? Because of our interest rate difference, the gap between our interest rate. So people are more likely to spend in to save their money into US market. And what happened recently is that because of the speculation of interest rate reduce or interest rate cut in US, and because of some economic data that I mentioned last week, there are few economic data that are disappointing, and people are thinking that US market or the Fed might cut even more than the expectation. So early last month, people are expecting the Fed to cut one time in the next 6 months of a 25 basis point, which is 0.25%. But after that some economic data that has been released last week, people are saying that the Fed is going to cut even more. They are going to be aggressive in cutting their rates, even up to 3 times. There are speculation from JP Morgan's, from Citigroups. There are people saying that. So with that, right, people are seeing so people are worried about US market, so that the people are start to worrying about it, and then people are pulling out their money. So when people are pulling out their money, US depreciate. So that what caused Ringgit Malaysia to strengthen. Well, after that, you ask about whether will it affect our import counters or export counters. Yes, definitely, because of the currency rate. But let us not forget about one thing. all the exporting companies, right, or counters, they will do some hedging in terms of currency. So we need to also study the companies, whether which level are they hedging their currency and their view on that. Because some company, if let's say they are hedging in the wrong way, then it will be a huge negative impact to them. So we need to study them particular, okay, in all respect, all right?
Yep. Also, ringgit also strengthened against other currency like such as Sing dollar. Okay, and I think today the Bank of Japan also came out to calm the market by saying that by giving a very dovish stance that the interest rate hike, okay, could be stopped if, I mean, could be temporarily halted if the financial market is unstable. So I guess they just want to uh, curb the surge of the Japanese yen, which may hurt the export industry as well.
Yep.
So yeah, I guess after that, the Japanese yen also tumble. Right. So next question here is that what indicators should we look at to determine whether a certain investment theme is in play or already ended? For instance, like artificial intelligence or data centers, what kind of indicators can we look at?
Okay, so very good question. Most of the economy data don't really measure or reflect the certain industry, for example, AI or data center that you asked just now, right? But there are few in data or research that we can do. For example, whenever we are looking at AI, right? I studied AI last year for quite some times, and then when we do the research, right, we start to look at even more detailed or specific data. For example, the country spendings or their investment in the next few years into AI implementation. Okay, so these are some of the data or indicators that we need to look at whenever we are looking out to research on certain industry. So for example, data center, it is quite small industry in Malaysia for us to research on right now, but we can research it at a larger picture where we can research on Asia Pacific scene or the overall market. Then you can see whether which country are spending more in expanding their data centers and why they are spending it. And then we can start to look back into Malaysia. Are we having some policies that are favor to all these industries so that we can know about it? But if you're asking me whether these indicators can tell us whether the booming or the trend is ending, I'm very sad to tell you that we cannot. Okay, because whether it will end, it comes to a few things. When the major thing will be the demand and supply. So demand and supply is not something that the supply side can do. So when we study about the the spending or the investment of that certain industry, they are major on the supply side. Okay, they're on the supply side. So we don't really can study on the demand side, but I think from there we can actually have a long-term view of the industry itself. So for me, I'm actually favor on AI, and also, but for data center, I am in the neutral stance on it in Malaysia in particular. All right.
All right, so that's all the time we have for question and answer session with Mr. George Po. So thank you so much, George, for sharing with us, how do we interpret economic data and events, and to teach us about the economic clock. So thank you so much, George, who is the
Okay, thank you,
co-founder
Shane,
of
and thank you everyone for the
eCameron.
time.
All right.